Okay, well, let's get to it. So hi and welcome. My name is Casey Boland. I'm a wealth advisor and partner here with HCM Wealth Advisors, and we have a special guest today. We are joined by Jon Dannemiller. Jon works for a company called Oswald and is a wealth of knowledge as he has done extensive work with life insurance, estate planning, executive benefits, business succession, disability insurance, and today he's going to share his knowledge of long-term care planning. So Jon, welcome. Thank you very much for being with us today.
Wow. Thank you for the introduction. And hopefully I can live up to all those things those nice things you said about me. So welcome everybody. Today we're going to talk really around long-term care planning. And that's really what I want to focus on. We'll get into some insurance conversations, but just a little bit of background on me. I've been in the insurance business for 20 plus years, worked alongside of advisors like Casey, helping their clients with the myriad of issues that they may have. Some of the things Casey talked about earlier on. Oswald Companies is an insurance provider. We don't work for a carrier, so we represent a multitude of carriers across the different lines of insurance that we offer to the clients that we work with. I'm from Cincinnati originally, or at least I moved here when I was 10. So I call it home, although I do say I'm an East Sider. So I'll stop there for a second and let Casey kind of give maybe the ground rules for what we're going to do today.
Sounds great, Jon. So a little house cleaning before we begin. If you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question, and Jon and I will do our best to answer at the end of the webinar. So, Jon, I'm curious, in looking and reading your background and the dialogue that we've had here over time, on your LinkedIn page, one of your titles is Insurance Nerd. So tell us, where did that come from?
Well, when you geek out on stuff like I do, and when it comes to insurance, after a while, people start to make fun of you and call you a nerd. And, growing up, and I'm not trying I shouldn't use names like this in a way, but I'm going to do it by poking fun at myself. So, you think of someone that might be, back in your youth called a nerd, and I'm actually pretty proud of it. I take a lot of pride in knowing the stuff that I know, knowing a lot of different things when it comes to insurance planning, financial planning, integrating different types of planning together. And I also take a great amount of pride in being able to put myself in clients' shoes. And hopefully that'll come across a little bit today.
And you know what? I certainly view Insurance Nerd as a compliment. And if you want help from an expert, give me someone with the title nerd any day. So a quick question before we begin. Are you a captive agent for Oswald, meaning that do you work for just one insurance company?
No, and it depends upon the line of insurance that we have. So we provide different types of insurance, from property and casualty to business to benefits, et cetera. So within each of those scopes, there's probably 20 or upwards of 20 to 30 different carriers that we might utilize. And who we utilize revolves primarily around, maybe the expertise with that particular carrier, given the solution or concept we're looking at. So in the long-term care insurance world, there aren't a lot of carriers, and I'll reference a few of them today. Or potentially reference them at least at a very high level. But not every insurance company out there offers long-term care insurance. So, but we don't hold ourselves captive to anybody and don't work for anybody.
Great. Well, that's fantastic. It enables you, I think, really to bring some of the best that's available out in the market then to clients. All right. So let's begin. So why are we having this conversation today with Jon about long-term care planning? Our goal at HCM is to help clients execute a plan to achieve financial independence throughout their lives. And at the end of life, many clients, they desire to leave an estate to their heirs, might be a charity, but along the way, not become dependent on their children. And a part of a solid financial plan is to understand the potential risks to a plan. And a potentially damaging risk is a long-term care event. So Jon, we're going to dive right into it. So let's just start the basics here with long-term care. So what is a long-term care event? What qualifies?
So in the world of medical providers, but really in the world of insurance, a long-term care event is defined as not being able to do two or more activities of daily living. So that's eating, dressing, bathing, toileting, transferring, continence, or being cognitively impaired. Typically in a situation like that, a doctor is going to say, and it's the client's physician that certifies whether or not the client can actually not perform these activities of daily living, or if they're cognitively impaired. So if the physician certifies that to be the case, then what that means is for those activities, those are not covered by normal, ordinary medical insurance or Medicare. So if you think of medical insurance or Medicare as covering things like doctor visits or hospital visits, or even going to urgent care and your prescription drugs. But if you cannot dress and bathe, say, as a result of a stroke, and you need assistance with doing that, that's not covered by, typically covered by Medicare or health insurance. So when you need to have if you can't do it, you need somebody else to do it. And that's where the costs come in.
So along the lines of the what, let's talk a little bit about the why. Certainly there's some important statistics that I think some people may understand and know, but we need to talk about it. So how about you share a little bit with us on some of the whys here?
Well, I think that a lot of folks, maybe even most of the folks on this call, understand potential for a long-term care event, but the statistics are the statistics. And what's happening is that we're living longer. So 33% of 65-year-olds are going to live to 90, and 1 in 7 are going to live past 95. And 70% of those 65 and older will need some form of long-term care in their lifetime. So the longer we live, the more likely we are to have a long-term care event, thus needing the care. I think the biggest thing, and this would be my goal for everyone attending this webinar today, is that having the discussion around long-term care planning is really, really important. And the fact of the matter is that most, or at least a good chunk of adults, have not had any discussions around potential long-term care, long-term care costs with their family or anyone else for that matter.
So that second bullet point mentions needing some form of long-term care in their lifetime. A lot of people think of long-term care and it's just in their minds nursing homes. So there are different types of care. Can you outline the types of care, just a quick, brief description of each?
Yeah, so think of it really as, so if you're not able to perform those activities of daily living, or you're cognitively impaired and you need help, that help is either going to come in your home or not in your home. So if it's in your home, it's going to, they call it home health care, maybe a nurse that comes to your home for a few hours a day. And this is really just going to depend upon the level of care that you need. So if you're not able to dress and bathe, that may only require someone to come to your house to help you with that twice a day. But if you're cognitively impaired and you're a danger to yourself, you may need somebody around the clock to facilitate or help with that care.
Yeah, and so it sounds like then, for people, the progression of care, that's going to look different from everybody, everybody. But any observations that you can relay on that?
Yeah. So most people, like as you said before, think of long-term care as being in a nursing home, and that's not how most events happen. So most events do not happen this way, where you're totally fine today and tomorrow you're in a nursing home. It's usually a progression. So a couple of examples. So think about you have a stroke and you lose mobility. You're not able to do two activities of daily living. You need a little bit of help. Maybe you have another stroke causing additional issues as a result of that, which means you need even more care. Or maybe it's a more of a chronic sort of situation where you have a bad back from maybe your job or whatever, and that just progressively gets worse over time, thus requiring you to receive more of that care.
So that last point, it really speaks to the power of procrastination and inertia. What have you found that has been ineffective in changing that perspective?
Well, I think that the number one thing that the clients really need to come to grips with, and that is that the possibility is real. The possibility exists. It's not just remote. It's probably more likely to happen than not, especially if you're talking about a husband and a wife. So have a conversation about what that's going to look like. We make a lot of assumptions in life, and I'm not trying to always make this to be the telltale situation, but I've had so many conversations with husband and wife together, and when you ask that question and they haven't had the discussion around it, and again, this is stereotypical, but one of them might say, well, the other ones can provide care for me, and the one who's not saying that's going, oh no, if I'm providing care and then they're gone or they can't help me, who's going to provide care for me? So having that discussion is important. And we'll get into it, I think, a little bit later, Casey, in terms of not just the financial impact, but the emotional or the family impact as well.
So to that end, let's shift to that. I think that's a great segue. So, we're going to talk about the financial cost in a bit, but there's much more to this, I think, as you said, and outside of the birds and the bees, having the other talk discussions about aging and care, these are difficult discussions. So what's been your experience, Jon, with how to have these conversations? Where do you start?
Well, I think it's a family meeting, and I know that every family is going to be different, and maybe all of them won't function this way or have it play out this way. But sit down as a family, and just if I'm the parent, the one that's concerned about having an event for me, I'd sit down with my kids and say, hey, I just want to talk to you guys about what this might look like, what's going to happen, and then get your input on it. So I'll give you my example. I have a brother and 3 sisters, and we sat down as a family with my mom and flat out said, listen, Mom, if something happens to you and you want any of us to help provide care, you do want your daughters to do that, right? And I know that sounds, chauvinistic, but it actually played out this way. My mom just got out of the hospital. She had some surgery on her pancreas, and she doesn't want me to come over and help her take a shower. She's totally fine with my sisters doing it. But that's the little things that, make sure you understand how that's going to play out. And don't just assume that kids will or will not provide care or want to be involved in the care. Maybe they're not actually going to come over and help, move you around, but they very well may want to help from a financial standpoint to make sure that, that all the I's are dotted, T's are crossed, the bills are paid, making sure that the providers are do what they say they're going to do, et cetera. And having those conversations are important. Even more so if the family unit, meaning the parents and the kids, aren't geographically close. Because the last thing you want to have happen is, you have a stroke, you're not able to communicate effectively, and one of your children is flying across the country to help provide care for you, and that's not what you wanted or what you would have agreed upon if you had the discussion.
Jon, I think those are all valuable points, and it's like a catch-22 situation where people understand it's important, but then when it boils down to it, those discussions can be very, very difficult. But from a parent perspective, while you have the ability to control that dialogue today, because at some point in time, there's the potential for a role reversal. And that's, I think, difficult for parents and children, or can be. And I think you make some great points about these different conversations. So I guess if you could, I guess, maybe add one more, if there's a story that you can think of with a client that either, whether something that had a positive outcome that you can share, or one that, maybe a story that we can learn from.
Well, I've been, I don't want to say fortunate. I've had situations happen where, as a result of the planning that happens from a life insurance or disability insurance or long-term care insurance process, that families have, as a result, are afforded the opportunity to maybe get a little bit closer, or at least understand what everyone's wishes are. I've had a lot of situations where, sitting and talking to the parents, and they don't want their kids to be involved, and they don't ever ask the question around it, and then the kids kind of feel left out, because in fact they wanted to be involved and help out. I've talked to many people that after the fact, and I know this is morbid and not necessarily a good thing to talk about, but after the fact, they helped their parent through the process, which ultimately ended in the parent passing away. But the child was rewarded in a way that they never would have expected by doing that. I was around when my grandmother passed away. I happened to be there. I stepped out of the room at the last minute, but my aunt continues to tell me to this day, and she was there the whole time and was taking care of at the end. She says, I would never have traded that for the world, to have been able to have that extra time with my mom, help care for her, kind of like she did for her, when she was younger. It totally impacted her life. So don't just assume it's not gonna play out that way.
So Jon had sent me some information. I think that's very helpful, because I think we could spend the majority of our time on this component of long-term care alone. And we want to make sure that we get to the cost discussion, the types of insurance coverages that are available. And Jon had shared a resource with me from Nationwide called Bringing the Family Conversation Gap. And bridging that. And we've got that document. That's something that we can share with everybody who's on the webinar. It's several pages, and I think it would be very, very helpful for families who are looking to have a starting point and have that type of dialogue with their family. So we'll certainly make that document available. So Jon, you mentioned before Medicare, from the sense that traditional insurance, what Medicare does not cover. So what does Medicare cover with long-term care?
So I've spelled it out here on the slide, but Medicare will cover up to 100 days of care in a skilled nursing facility. So skilled would mean that you need something even beyond. So typically the cost of long-term care. So think of all of those activities: eating, dressing, bathing, toileting, transfer, incontinence. Those do not require skilled care, but skilled care may be physical therapy or occupational therapy, or changing of bandages or something along those lines. So it does cover up to 100 days, and I'll break it down in a minute, in a skilled facility. But you need to have been admitted, to a hospital immediately prior to that, or within 3 days. I'm sorry, being 3 days in the hospital. So, if you don't go to the hospital first and be admitted, you're not going to have Medicare cover any of your long-term care event. So they're going to cover 100% of the first 20 days, and then there's a $200 a day copayment on days 21 through 100 if they approve the stay in the skilled facility. So there's a lot that Medicare won't cover versus the very little bit that they do.
Okay, how about then let's shift to Medicaid. What does it take to qualify for Medicaid?
So Medicaid is the government's response to folks that don't have the ability to pay for things on their own, but they make it difficult to qualify for it. So there are two tests. One is an income test. So if you're an individual applicant, meaning you're not married, your income would need to be below $32,904. And you have to satisfy both of these tests. So that's the first test. If you're a couple at $65,808. The second test is actually a little bit harder, and that's where you need to have your assets below a certain amount. So for a single person, they need to be below $2,000. If you're both applying for Medicaid, then it would be below $3,000. If you're married and only one of you is applying, the way the Medicaid formula works is they take your joint assets, so add up both the husband's assets, the wife's assets, divide it by 2. So that becomes each person's assets. The one that's applying needs to get down to that $2,000 number. So if let's use an example of, let's say you had $300,000 of combined assets, divided by 250,000. Let's say the husband's applying, he would have to spend his 150, so he'd have to spend 148,000 to get down to 2,000. The wife would need to get down to 148,620. So in her case, she would also need to spend an additional $1,380 before the husband would qualify for Medicaid. So in most situations, or I shouldn't say most, there's a lot of situations for clients that have a decent amount of assets where it would take a lot to spend it down to be able to get onto Medicaid.
Yeah, and it's interesting. Looking at those figures, it seems you can have a reasonable amount of income, but little in assets with that combination. So are there planning opportunities there to help somebody based upon that?
Absolutely. So two big areas that elder law attorneys will utilize is converting assets to income. So you can do that with an annuity type of product where it takes an asset today, converts it to an income stream. It doesn't have any value once you've passed away, but it'll give you an income stream for the rest of your life. So that's one way to do it. So converting an asset into income. And then the other approach that oftentimes will get taken, especially in a setting with a couple, is equity in a home does not need to be tapped into until that equity amount exceeds $500,000. So another way to shift assets would be to shift them into a home, paying off a mortgage, for instance, if you still have one, would be a way to at least temporarily shelter assets that would be made available to the other spouse.
So it might be putting money into the home and the equity, doing some improvements on the home and things to add value potentially.
For sure. I would definitely have conversations around that. And again, hopefully all of this talks kind of reinforces the concept of planning, having a conversation around it, thinking about what it's going to look like, how you would go about strategically, taking care of yourself or your parents or your spouse.
Awesome. Okay, so let's talk about costs. So Jon, give us a perspective on the range of the different costs involved with the different types of care.
So again, remember we were talking about normally long-term care events don't mean today you're fine, tomorrow you're in a nursing home. So these ranges really have to do with the amount of care that's necessary, not so much the quality of care. So it's not like in the Cincinnati area today, a long-term care event could cost anywhere from $32,000 to $116,000 a year. That doesn't mean like the 32,000's, the cheap place and the 116 is the expensive one. That really is more a function of, okay, so at 32,000, you're having a nurse come in, 3 times a day or twice a day, doing, the things necessary to allow you to function from an activity daily living standpoint, whereas the 116 may be around the clock care in your home or in a nursing home. The other thing to think about is that because a long-term care event, you normally, hopefully you're not planning it the day before it starts. But normally, if you're thinking of this from a financial planning standpoint, and what I mean by that, and we'll talk about this a little bit more too, is put it into the context of what this would mean to your overall financial situation. And the only way you can really do that is extrapolate out what that cost might be in the future. Because if you're looking at this when you're 60 years old, you might not have a long-term care event until you're 80. So you really need to look at what that cost might be, in 20 years. And as you can see from the graphic, in 20 years time, that cost is almost doubling, or in some cases more than doubling. And it's really important to forecast that in. We've utilized, I think here, Casey, a 4% inflation rate. So in other words, inflating the cost by 4% a year compounded. And we can, through the financial planning tools that Casey and his team have available, we can definitely look at multiple scenarios there.
Yeah, I mean, it's really eye-opening when you look at the numbers, and it's while the numbers in today's dollars already seem pretty staggering sometimes when you look at the figures, and 4% inflation is not that much, but certainly the compound effect over time, it's pretty dramatic of what people may experience down the road. And yeah, to understand what the implications are going to be if you have to deal with that for a extended period of time. So this resource was from Nationwide. And this is something else that Jon shared with us that we're certainly glad to share with webinar participants. You can then look at your own specific area and then have an idea of what the cost of care for the different various types for your state and region. All right, so moving on, I liked this graphic. Certainly with this arrow, is the cost of care increases, meaning that arrow is going to the right. The probability of success, which is on the left side, decreases. People want to understand the cost of care, what is their financial risk associated with a long-term care event, and there are ways to try to model to give one an understanding of the financial risk should they experience a long-term care event. So Jon, what is your approach to quantifying financial risk?
Well, it all comes down to the financial plan. So I would highly encourage clients to utilize a financial planning tool with their financial advisor, because it allows the client and the advisor together to put inputs in. So let's just argumentatively say a client says, you know what, I think I have enough assets and I'm going to self-insure. Well, through the modeling that Casey and his team can do, we can forecast what a long-term care event might look like. So as an example, we're going to take a long-term care event in today's dollars. We're going to inflate it by 4%, have the long-term care event start in 20 years and have it last for 3.5 years. What would the financial impact of that be? And given everything else within the financial plan stays the same, or a multitude of other things. And that's the beauty of financial planning software, is that it allows you to put a lot of different inputs in. So, you can do all kinds of inputs. I'm not going to get into all those, but by doing that, though, you can really see the effect of it. So if your goal was to be able to, pass $500,000 of assets onto your children, and you have that long-term care event that I just described, and it wipes out your assets, that may be fine, but you can actually see it and then make decisions about whether or not you want to do additional planning to mitigate that situation. Yeah,
I think well said. And this is a place where someone can appreciate, I think, a partnership with HCM and your expertise, Jon. So clients may recognize the screen, and certainly we have some sophisticated financial planning tools that we can really help assess that risk. And oftentimes we still find, though, that clients that, even though they may be in a good position financially, based upon what they want to leave as an estate and the peace of mind factor, still oftentimes they may look to have insurance coverage just to make sure that they can protect a surviving spouse or their heirs, and again, make sure that they leave assets to their children. All
Yeah,
right, so
that's also easy to model in too. So if you wanted to look at what an insurance policy would do, should you have an event, and I always model it or ask the advisors to model it, look at the insurance, with the event, but also look at buying insurance and not having an event. So what's the financial impact of buying insurance and not actually having a benefit payout? Because I think that's important.
Sure. No, I think well said. Okay, so moving on now to the types of insurance products that are out there. How has the long-term care market changed? I mean, it seems to be considerably less companies in the market. You kind of mentioned that earlier. People have heard stories about their existing premiums. Some people have seen pretty substantial increases with premiums. So where's the industry today and what has changed?
Well, a lot has changed. So traditional long-term care, I'll talk about that first, but that is the type of product that has probably changed the most. But it's also probably the one that most people are familiar with. So, and this is just conceptual. This is not talking about any specific insurance company or product or anything like that, but traditional long-term care has been in the market for a long time. And a lot of people think of it as like nursing home coverage or something along those lines. Because when it originally was brought into the market, that was the long-term care event, was going into a nursing home. The idea of having care in your home outside of care that would be provided by your family was just not something that people did. So in the traditional long-term care space, think of it as functioning similar to like homeowners insurance or car insurance. So think about, if you've had a home for a long time and you've paid homeowners insurance for a long time and you've never had a claim, you run the risk of never having a benefit payout. Now, most people look at that as that would be a good thing, right? But traditional long-term care functions like that. So there aren't a lot of options in the market. So this is where we've seen tons of carriers exit. Very few carriers in the market, harder to quantify the risk. They've miscalculated the risk over time, and that's why we've seen an increase in premiums. So if they thought that when they sold a policy that the average long-term care event would start at 80 and last for 3 years and the client would pass away, now, when the event does happen, if it starts earlier or goes longer, then the insurance company's paying out a lot more than what they thought. So instead of letting an insurance company go out of business, which would be bad for other insurance companies as well as the state allows the insurance company to apply for an increase in premiums. And if they can show that their actual claims experience is different than what they forecasted when they designed the product, the state will allow that premium increase. So because these products and their design, they were originally and have always been this way, where as long as you pay the premium, you have the coverage, but the premium can increase. So it's made it maybe more difficult for clients to pull the trigger to buy something like that because there's two things going against it. One is the use it or lose it proposition, because on that homeowners insurance, if you never have a claim, they don't pay you back anything. Same holds true for traditional long-term care. And, those premium increases, if you've seen clients that have had or friends that have had those policies with premium increases, that scares people off. All of that being said, my argument would be that I feel good about the traditional long-term care space because what we've seen from an increase in life expectancy over the last 20 to 25 years, that's actually slowing down. And the other thing is that insurance companies have gotten their arms around that in-home claims experience and the change in family dynamics that have happened over time. So 20 years ago, the nuclear family, a lot of the kids would have lived close by, potentially helped provide care. Now you have families where the kids move away, aren't in a position to do that. So insurance companies have taken all of those things into consideration. So that's a high level overview of of traditional long-term care.
So John, earlier I had a question from somebody that came in and they were just asking, hey, if my spouse and I are close to the same age, 62, 63, and if they want to cover about half of the typical benefit for a couple years, I know you can't give precise numbers, and certainly that can be a compliance issue, and everybody needs to know that premiums can range. But can you give a rough idea what a premium range may be with a traditional policy for a couple in that instance?
And given that age, and potentially covering upwards of half of the cost, I would probably put the annual premium in the $5,000 to maybe $8,000, $9,000 range. There's also health to consider as well. So, if somebody has some pre-existing sort of conditions that would potentially cause a claim to happen sooner, that would drive the cost up as well.
Sure. So, all right, let's look at then option number 2. So the long-term care and chronic illness riders on life insurance policies.
So this particular area has actually seen a huge increase in the offering in the marketplace. It's a little easier to, or I should say, it's kind of easy to understand. So think about a life insurance policy. If I have a life insurance policy on my life, and let's say it's a permanent policy, so it's designed to be enforced for the duration of my lifetime, and let's say there's a $500,000 death benefit. When I pass away, that $500,000 benefit goes to my beneficiaries who I've designated. If I add a long-term care or chronic illness rider on it, then it allows me as the policy owner to access that death benefit during my lifetime on a tax-free basis. They limit the amount that you can access. So typically it's at between 2 to 4% per month. So in the example of $500,000, you'd be able to access $10,000 a month. As you access that benefit for long-term care, that $500,000 drops dollar for dollar. So if I take out $100,000 that's used for my long-term care and then I pass away, I would have extracted $100,000 from the policy during my lifetime. The remaining $400,000 would go to my beneficiaries.
Interesting.
Yeah. I mean, they're easy to understand. It's a way for a client to create some flexibility. And this was, everything about this is planning and flexibility more than just trying to figure out which is the best product, if you will, to buy. But it can create some flexibility. It can also create some hedging from a tax perspective too. So if you have a lot of assets that might have to get taxed as a result of accessing them. So think about like qualified money in an IRA or a 401k. If you have to tap into those to cover your long-term care expenses, you're going to pay a taxation on the distribution from those accounts to pay for your long-term care event. This particular contract here, as I've illustrated or described it, those benefits would get paid out tax-free.
Gotcha. So how about unpack number 3 here? There's a lot to this. So linked benefit hybrid long-term care.
This is the most popular product in the market right now. And by the way, the life insurance policy with the long-term care rider number 2, those can be designed so that the premiums will never increase. Okay, and so options 2 and 3 specifically are very much are very popular because we don't have the possibility of those premiums increasing. But number 3, the linked benefit product, it functions a little bit similar to number 2, but instead of having all of that benefit packaged in the form of death benefit, some of it's in the form of death benefit and some of it's in the form of additional long-term care benefit. So let's say that I buy a policy that has $150,000 of death benefit and let's say $350,000 of additional long-term care benefit. If I don't have a long-term care event at all, the $150,000 goes to my beneficiaries. If I have a long-term care event, I access that death benefit, that $150,000 amount. I access that first. Once that's depleted, then I tap into the remaining $350,000. If I don't use up all of the $350,000, I've, basically taken the death benefit to zero. So there's no ancillary or remaining benefit available to beneficiaries. This product number 3, the biggest difference between 3 and 2 and why clients gravitate towards it is it has the ability to be inflated. So in other words, if I buy a benefit today that has $150,000 death benefit and $350,000 of additional long-term care benefit, I can inflate that at different percentages. There's different options with that, so that both of those numbers increase over time. So that at the point when I have the event, I have more coverage in place than when I initially bought the policy, and my premium stayed the same the whole time.
Gotcha. And then lastly, how about the long-term care rider on the annuity?
This product here is, and this is my opinion, so I'm going to say that first. But this product here is utilized in the marketplace more for simplicity type of purposes. So if you think about an annuity, a lot of annuities have what are called income riders on them. So if I put $100,000 into an annuity, I might be able to turn on what's called an income rider that would allow me to take a percentage of that 100,000 out in the form of income and have that last for the rest of my life, no matter what, how long I live. Now, the remaining amount to the beneficiaries may be depleted depending upon how long that is. The long-term care rider on the annuity allows you to access a higher percentage amount if you qualify for the long-term care event. So if, let's say that it was 3% and you can double that with having that long-term care rider on it. So if you had 100,000 and the regular income rider gives you $3,000 a year of income, the long-term care rider would give you $6,000 of income. Where I said before, I think the simplicity is overstated in a way. The downside to these products, in my opinion, is that you have to put quite a bit of money into them in order to have any sort of meaningful long-term care benefit. And the money that you put into these products don't typically grow. Well, they will grow, but at a much lower rate than what the market might have done, even in a fixed income or low interest type environment. So there's a sacrifice there to have that. Most of the time, again, sold for simplicity purposes, these long-term care riders on annuities do not have the underwriting component to them that the other products do. So for someone that isn't as healthy, they would be easier to get.
Gotcha. So you mentioned something earlier regarding, life insurance. It kind of prompted a question in my mind. Can you convert other types of insurance into another type of policy then that can help deal with these long-term care expenses?
Casey, thank you for asking that question, because I actually had a note to make sure I discussed it and I totally missed the note. So another reason why these linked benefit products are popular is that some people have accumulated cash value in permanent life insurance products, oftentimes whole life insurance products. And when they're doing planning, they're looking at, this policy that they have. Let's say they're paying a premium. They're looking at the death benefit. They're looking at the cash value. They're trying to figure out, okay, do I really need this death benefit or not? Could I use the cash value another way? Well, a lot of clients will take that built up cash value and, in effect, convert it from a death benefit amount, because that cash value supports the death benefit on the existing life insurance policy, convert it to one of these linked benefit products that now provides a much more meaningful long-term care benefit. The death benefit may be lower, but the client had already decided that the death benefit wasn't as appropriate or needed. So it makes sense from a planning standpoint.
Yeah, I think that's a great use of potentially having flexibility of life needs change, and going from the death benefit protection now being able to adjust that and maybe maneuver that for long-term care. So that's, Jon, that's a great suggestion. So we've come to the end of our program. So Jon, thank you for sharing your knowledge today. It was extremely valuable. And if you'd like to contact Jon, you can either coordinate with your HCM advisor or contact him directly I've got his contact information up on the screen, and certainly we'll share that in the webinar, and we'll be able to send that out to folks as well. So I hope that you've enjoyed our webinar, found your time this time valuable. There's a reason we've chosen to partner with Jon. Jon's an expert in the field and the integrity and doing what is best for the client. Do not hesitate to reach out to HCM if we can help you coordinate long-term care planning with Jon or other planning matters for that. So thank you very much for your time, the confidence you've placed in HCM, and have a wonderful day, everyone.